Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone, and welcome to the Millionaire Next Door podcast. Really pleased you're here with us for conversations that matter. Today, we have a terrific guest we've had on numerous times. Phil Huber, he's the head of portfolio solutions and a managing director at Cliffwater. He's covered private markets in the past, equity, debt, a lot's going on in that space. Welcome, Phil. Phil Huber, how are you?
I'm doing great, Robert. Thanks for having me back. It's always a pleasure to have these conversations.
Yeah, it's terrific. You've given a lot of terrific insights, and I know you're deep in a lot of research in the space and helping people understand that. An area we might want to focus on today is private credit. That's been in the headlines a bit lately. So give us your thoughts on that. What's going on there?
Yeah, I thought that'd be a good place for us to spend time. I know in some of these prior conversations, we've gone a lot of different directions within the world of alternative investments in private markets. But I would say just given the increased headlines around private credit specifically and us being a bit of a specialist in that arena, I thought it really made sense to really focus today's conversation on kind of what's happening, what maybe folks are reading about in the financial press and how to make sense of all of it. Where there's been a lot of, I would say, negativity around private credit this year, it really falls into a number of buckets. I would say one would be related to defaults, which is kind of part and parcel for investing in any credit asset classes. You're being paid for bearing the risk of default. So you shouldn't necessarily, as an investor, be overly concerned of defaults happening in general. That's just kind of the nature of the asset class. You're going to have some borrowers at times that run into issues and realize credit losses. That's the nature of the beast. Hopefully, over time, those losses are manageable and significantly lower than your income that you're receiving as an investor. But it's something that you shouldn't be scared away from the asset class just because defaults occasionally exist. It's something you just have to live with in investors, but it's something that I think the news and the press has been a bit more focused on. There's been a handful of high profile defaults over the past 12 months, we'll call it. Some of those weren't even in the world of private credit or direct lending. They were in other parts of the loan market, but they kind of got lumped all together, which we can speak to in a little bit. I would say other stories that people may have come across have been around elevated redemptions from certain types of private credit vehicles, things like interval funds or BDCs that offer partial periodic liquidity for investors, but not full access to liquidity at all times. And so when you have periods of stress where more investors want their capital back and they might not necessarily be able to access 100% of it at each window, then of course that makes for good headlines as well. Concerns around valuations, and maybe this dovetails into the theme around AI, which of course is really driving all markets today. It's really the big story across public and privates, which is this AI wave that we're living through and the ramifications or impacts it might have on other business models and in particular traditional software companies, both public and private. And so I think that is what maybe sparked some elevated worries about private credit, which is that software companies are one of the larger categories in the asset class in terms of borrowers. And so I think there was worries about how are the valuations of these private software companies going to be impacted by advancements in AI? So that's hopefully setting the table a little bit. I would say the other thing more broadly, and this is not anything new in the past 6 to 12 months, but rather this has been a persistent bias, in my view, from the financial press around private credit over the past, call it 6 or 7 years, which is to say that anytime you have an asset category or something that seems like it's growing a lot over a relatively short period of time, I think naturally it attracts scrutiny. And so while certainly private credit is significantly larger than it was 5, 10, 15 years ago, growth doesn't occur in a vacuum. There are very sound reasons as to why private credit has become a preferred source of debt financing for private companies, largely those backed by private equity sponsors. And so when you look at the growth of private credit in conjunction, not just with the overall growth growth of private equity, which is where most of this lending activity is taking place, but also who used to be doing this lending that is no longer doing as much of it. And I think that's the other large story, is that the big growth cycle for private credit really started taking place in the early 2010s, post GFC environment, where banks, due to higher capital constraints and regulatory constraints, had to really step back largely from that type of lending activity that normally used to sit on bank balance sheets. And that's a big part of why private debt grew the way it did. It was really stepping in to fill that void. That's my brief summary, hopefully, of the headlines that are out there. And we can spend maybe the rest of the conversation trying to unpack some of those themes.
Yeah, no, that's really good and really helpful. You're mentioning AI. It's obviously the topic of the day, not just the day, but of our generation, right? We're seeing it, and just made me think maybe it's introducing risk and opportunity to every asset class. It's going to change a lot of stuff, even to talking to my adult kids, the anxiety around it, it's going to change their life. So in some positive, some negative. So maybe that it's just interesting how that's evolving. A lot of money did flow into the private credit space due to its attractiveness. Obviously, its returns and its lower risk profile relative to other asset classes. Maybe talk about that, and how big really is private credit? Just to give people a scope of valuations, how big is that market? Maybe talk a little bit about that. What are we looking at?
Yeah, the market, I think it's always important to put things in context, because when you start to throw out numbers like, we'll call it 2.5 trillion, as maybe a rough estimate of the size of the total private debt market today, anything with a T, like a trillion, it sounds really big in isolation. I think importantly, you sort of need to contextualize that around what do other markets look like. If we look at all of private capital, so you throw in private equity, venture capital, private real estate, private infrastructure, you add all those together, it's about $15 trillion today. So even at 2.5 trillion or so, still a minority of the total private capital market. And then you start to look at things like, okay, what about public markets, global equities? Estimates maybe 130 to 140 trillion, massive. Global bond markets, again, 140 plus trillion dollars. So in the grand scheme of things, relative to the total investable opportunity set, these are really relatively small still. They've come a long way, and they're becoming more, I would say, actively allocated to, not just by institutional investors, but by individuals and their financial advisors as well. And we expect that trend to continue as the benefits of these asset class, both from a return potential standpoint as well as the diversification benefits they offer, naturally allocators of capital continue to find a role and a place for them in a diversified portfolio. But we just saw the SpaceX IPO, what was that, a week or two ago? That IPO'd at a valuation of roughly $2 trillion. You have one single private company that IPO, the largest IPO that we've ever seen, in and of itself, roughly the size of the private debt market. So I think that hopefully that maybe level sets a little bit, that it's all relative, and scale in and of itself, or size in and of itself, is not necessarily a reason for scrutiny, but it's just a natural byproduct of when we saw things like crypto, and that started to get a lot bigger, and it drew more scrutiny, more attention. And so it's not surprising that we've seen that same sort of treatment for very different asset classes, of course, different risk return profiles. But I think as much as we have data, Cliffwater going back 20 plus years, examining the long-term risk reward in direct lending, for a lot of folks, it's a bit newer. They weren't maybe as actively researching or investing in the space up until maybe a few years ago. So it does seem for a lot of folks like it maybe came out of nowhere at this massive size. But I think importantly, this growth has taken place over 2+ decades.
Okay, and so interesting. I'm just kind of waxing. I've been doing this 28 years now, second and third generation clients, and now trillion is such a common term to hear, right? It was never used before, and it's still even hard to get your head around that size of that space. Micron Technologies just became a $1 trillion company. I think there's only about 10 to 12, maybe 13 companies out there, and it happened in 48 days of a massive growth. So it's just interesting, but this whole private credit space is roughly the size of a company called SpaceX that just came public.
Yeah.
So
And when you look at the asset class itself, there's many different types of private credit. The largest
Mhm.
segment is what's called corporate direct lending, which is loans to middle market businesses, predominantly in the US, that are backed by private equity sponsors. When you look at that universe, we're talking roughly 10,000 borrowers. So this is a large subset of meaningfully sized companies. These are not really tiny companies. These are typically companies with anywhere from 50, 75, 100 or more $1 million of annual earnings. And they also represent a significant portion of the US economy in terms of contribution to GDP growth and number of people employed. And so this is a massive market of businesses that are growing and profitable and really part of the backbone of the US economy. And so it's important that they have access to debt capital markets.
Good. For our listeners, just to help them understand, it's a little bit of a jargon term middle market. Can you maybe help people understand what that means, and maybe even an example of a tangible company or business, and just so people get a little flavor of what's the backbone that they might not be thinking of, and then you're giving them access to things that are not part of the public markets, right? They're not in their 401ks just to people understand a little bit better. I thought that might be helpful.
Yeah, I would say I probably need to avoid individual names for
Oh, that's
compliance
okay.
reasons, but I would say
You could
just in
just,
terms of first of all, what it isn't. This is not loans to early stage startup companies, two guys in a garage somewhere with an idea and no revenue. It's not that. We're not lending to those type of businesses. These are usually more mature businesses that are already in profit mode. They not always, but often are owned in part or in full by a private equity company. And so they have that backing of equity capital behind them as well. What you tend to find is that the range has kind of shifted over time. Maybe 10 years ago, the quick math was kind of like middle market was companies with 10 to $100 million of annual EBITDA. Fast forward to today, that definition is maybe kind of moved up a little bit, in part just because naturally,
yeah.
dollar amounts go up over time with inflation, but think of it more maybe 25 to 250 million. And I think part of why you see larger borrowers too as part of that universe is that you see a little bit more competition amongst banks at the upper end, where direct lenders are more competitive than they were 10 years ago. And so you tend to see some larger borrowers that maybe weren't necessarily considered core middle market. We call that kind of upper middle market today. That's part of the borrower set as well. And so it's pretty vast in terms of you have kind of lower middle market, core, and then upper middle market, and then with different risk profiles for those different borrower types. But just to put some kind of round numbers on it, maybe think 25 to $250 million of earnings would be the types of companies that are accessing these loans.
Great. And maybe dive a little deeper. What are investors actually buying? I know there's senior secured loans and creditor protections. Maybe get into that a little bit, how those
Yeah.
look.
So really it's loans to businesses. So you're not investing for upside potential like you are with stocks. You're investing for a contractual income stream. You're investing in a loan that has a finite life, often with a stated maturity of kind of 5 to 7 years. What we find in practice is that a lot of companies end up refinancing or repaying their debt early. So you tend to have an effective maturity of these loans of between 3 and 4 years. So relatively short duration. They're typically floating rate notes or floating rate loans. And so they're not as sensitive to interest rate movements as traditional bonds might be. And so as short-term interest rates go up and down, so too does the yield on these loans. So it's really more of a pure credit risk that you're bearing as opposed to interest rate risk that you're being exposed to. It's contractual loans. Often you're at the senior portion of a company's capital structure. So what that means in practice is that if things go bump in the night and a company runs into challenges, you're first in line to be paid back as the senior creditor. And so you have a lot of kind of first and second loss capital in front of you, both in the equity holders of these businesses, as well as potentially those that hold more junior debt in the business as well. And so what that it's led to over time is a return profile that's really driven by income. If you think about what investors experience in real life, it's income is your upside, and then you have credit losses, which you can hopefully mitigate thoughtfully over time in different ways. And then you have fees and expenses. Just in practice, you allocate to this asset class through funds, which have their own economics that can detract from returns. And so the way we view this asset class at Cliffwater is, number one is in credit, you're not rewarded for being a hero. What I mean by that is you're not compensated for making big bets. Sometimes in stocks, if you make a concentrated bet, it can really pay off in terms of you've got this unlimited upside potential. You don't have that in credit. All the risk is asymmetric to the downside. And so we believe very strongly in this asset class that diversification is your buddy. You want to really spread your bets and maintain very low position sizes, often with an index like profile of many different hundreds, if not thousands, of underlying loans to really try to mitigate that idiosyncratic borrower risk. And then we think there's, again, like any private market asset class, there's going to be larger dispersion between your better managers and your managers. We see much greater dispersion in private markets than we do in public. And so we think there's potential value to be had from strong manager selection as well. To hopefully, you're not going to completely avoid losses in this asset class over time. At the index level, at the market level, what we see historically is about 1% annualized credit losses. So think of that as a function of two variables. You have default rates, which historically have been about 2%. And then you have recovery rates, which have averaged about 50%. So you multiply those two, that gets you about 1% annual credit losses. Of course, not everything works in averages. You're going to have lower than average years and higher than average years, but that's what's kind of been the experience over the 20 plus years of data that we have. That being said, that's the market. There are managers that have phenomenal track records of much lower than industry losses as well. And so we think investors in the space have enough access where they can hopefully capture the yield that the asset class offer, but limit the frequency and severity of losses. And of course, fees and leverage also can drive returns. And so that's something that investors should play a critical lens towards as well when they're evaluating different products and different structure types.
All right. How does it compare risk-wise to traditional public bonds? How's that work?
As you're aware, Robert, there's no free lunch in investing other than maybe diversification. When you look at yields in different parts of the income markets, those should be evaluated in the context of risk. And of course, the more risk you're bearing, the higher yield you should be expecting as compensation. And so if we go on one end of the spectrum of something like T-bills, which are AAA backed by the US government, no short term, so no interest rate risk, that's going to have a much lower yield. Whereas you go to something like private credit, you're going to have a much higher yield. It doesn't mean one is naturally worse or better than the other. They play different roles for investors, but you should not look at something like private credit as a substitute for short-term cash or short-term liquidity or investment grade fixed income. So you look at these on a spectrum. The question is not, is one riskier than the other in terms of potential for credit losses? The question is, are you as an investor compensated for the risk that you're bearing? And so what we have is over the 20 plus years that we have, what we've seen is that direct lending has meaningfully outperformed both investment grade core fixed income, but also non-investment grade public fixed income. So think high yield bonds and leveraged loans. And we view that as not only in private debt are you compensated for bearing credit risk of non-investment grade borrowers, you're also holding these loans typically to maturity. There's no secondary market for trading, and you're bearing an illiquidity risk as well. And so that's another risk premium that investors should be compensated for. So when you stack those up together, that's what we found is really attractive about this asset class is that when you juxtapose that with things like high yield bonds that have similar credit loss profiles over time, you've been compensated with higher returns in direct lending. And we view that as really just pure compensation for their illiquidity. So for investors that have some budget in their portfolio for non-daily liquid investments, this could serve as a great complement to your kind of more safety oriented traditional core investment grade fixed income that is going to be more rate sensitive. And so we think when you think of things like almost like a barbell approach, it's important maybe to separate those two risk factors a bit. And something like high yield bonds too is interesting where that's a little bit of a hybrid where it's got both rate sensitivity because it's fixed rate, not floating, but it's got credit risk as well. And so it's hard to disentangle those two variables where in direct lending, it's a little bit more pure credit risk.
Yeah, that's really helpful. Part of our role has been guiding folks, private clients, into this where it's appropriate. Obviously, this asset class has been used extensively by institutions and they have sophisticated investment committees. They understand all this, where it fits in a portfolio. Maybe talk a little bit about how they're behaving versus the retail client during a few of these minor hiccups, but headlines and whatnot. I'm just curious what differences you're seeing, or is there a difference?
Very, very much. When I look at the total AUM or size of private debt, our estimates show about 15% of that 2.5 trillion is considered to be retail or more like private wealth oriented vehicles. So it's still, even though it's grown quite a bit in the grand scheme of things, individuals represent a fairly small minority of the total asset class. But it's the part that's getting all the headlines and all the attention today, because that's where the redemption activity has been taking place, is through vehicles offered through, typically through financial advisors that make their way into end individual investor portfolios. If we contrast that redemption behavior with what institutional investors are doing, we see a very different picture. We see institutions continuing not just to reaffirm their conviction in private debt as an asset class, but in many cases increasing and trying to maybe capitalize on potential opportunities that may arise when you think about supply and demand and capital
Hmm.
flowing in and out of asset class. Asset classes naturally, when you have a spread oriented asset class like private credit, when more money comes in, spreads tend to tighten. When money exits, spreads tend to widen. And so, if you think about from a long-term investor framework, if you're not one of those folks that's heading towards the exit and have your conviction, you should hopefully take some comfort knowing that over time that should lead to more normalized spreads and higher expected returns for those that are staying put. And that's true. What we find historically of most asset classes is that patience and discipline tends to pay off. Periods of lower returns tend to be followed by periods of higher returns, et cetera. And what we find is just I think, not to paint too broad a brush, but I think individuals, because they're not as close to the investment process day to day, are a bit more susceptible to reading scary sounding headlines and having a bit more emotional or knee jerk responses to those. And that's not their fault. It's really the business model of the press is designed for clicks and engagement, not necessarily for
Yep.
nuance. It's really about how can I create some sort of visceral reaction with some kind of, whether positive or negative, with a headline or a short article. And so a lot gets lost in that. And so it's no surprise that when you see a lot of these stories start to come to fruition, they tend to be fairly one-sided, and they tend to come off as kind of scaring people. And I think what we find institutions, the way they behave with their allocations, is that they take a very long-term view. They establish very well-defined parameters around their strategic asset allocation. In other words, how much do they want to own of public stocks, public bonds, private equity, public private debt, all these different asset classes they allocate to. And when they do make changes, it tends to be more at the margins. I think right now what we find is that it's very polarizing in the press, and what you find in kind of the retail world, which is like this, you either got to be all in or all out on something. You've either got to think it's the greatest thing since sliced bread, or it's the next financial crisis. There's no room for in between. Institutions, I think, take a much more balanced approach, which is not to say that they don't adjust their targets here and there, but it's a little bit more at the margins, where they say, hey, these are risks and return streams that I want to own for the long term. At various points in time, maybe they look more or less attractive, but it's not wholesale changes. It's not jumping in and out. And in particular, I think that's the right move, because not only do investors, both institutional and otherwise, have a generally poor track record of market timing. At least with public markets, you can change your mind very quickly. Private markets, they don't lend themselves well to tactical approaches or market timing. And so I would say, going into these asset classes, whether it's equity or debt in the private space, really does require a long horizon. And for those that maybe aren't comfortable with that, or maybe aren't comfortable sacrificing daily liquidity or that ability to change their mind in a moment's notice, maybe it's not the appropriate vehicle or investment type for them. Like anything, there's not everybody needs to hold every single asset type in their portfolio. People need to find what works for their own appetite for risk, their own return objectives, risk tolerance, et cetera.
No, that's great. Super helpful. A giant, and I loved all that, the clickbait or just all the stuff out there. A giant factor in my process, my team, is just helping folks separate the signal from the noise. Objective, unemotional, rules-based process, and following it consistently. Because not following it or saying this is an exception is akin to having no process whatsoever. So, starting to wrap up a little bit, and you might have already covered this to a large extent, but how should investors separate the signal from the noise? And also, what's the biggest misconception about private credit today?
Sure. I think in terms of separating signal from noise, it's hard for anybody, even professionals, to tune out the headlines. We're all, especially in this day and age, we're
Mhm.
all on social media, we're all inundated with alerts and everything. It's hard to stay away from that kind of 24/7 news flow. And we need to kind of train ourselves to not overreact to everything that we see. Not all pieces of information they might be interesting, they might not be actionable. And so I think the more we can incorporate a process-driven approach to our investments, the more we can create a rules-based framework in how we make investment decisions. It does help take some of that emotion out of the equation. I always say too, when in doubt, zoom out. It's always helpful during periods of volatility, and this is true for public markets as well, is we tend to extrapolate and we assume that when things aren't going great, that's going to continue in perpetuity. So it's always,
Yeah.
I think, good to take a step back and say, okay, maybe this is a weaker period of returns for a given asset class. What has it done over longer stretches, 5 years, 10 years, 20 years, longer, and over those longer time frames? What has been the range of outcomes, and just something to help mentally prepare for, hey, like there are no bulletproof asset classes. If there were, that would just be the entirety of what we own in our portfolio. The reality is that everything has its ups and downs. The key is, how do you find things that have their own long-term risk premiums, and then to find other things that can be complementary, that are independent return sources, that you package them together in a thoughtful way and creates a steadier return for your entire portfolio over time. But this idea that you're going to avoid losses anywhere is just, I think, a little bit misguided. I would say for those that maybe were invested, we'll use private credit for an example, since that's what we're speaking to today. Some folks might be wrestling with, did I make the right decision? And really what's interesting about this dynamic with the elevated redemptions we're seeing across the industry is that usually when you see a lot of outflows in a given category, it's because performance has been poor. That actually hasn't been the case in private credit. That's why it's been a bit more puzzling, is that performance has actually been pretty strong. When you look at any trailing period, it's continued to outperform public market equivalents. And so those that are exiting are not necessarily exiting something that's delivered them bad results. I think there's just a bit more worry about looking ahead and a bit more speculation on what the future might look like. And I would say, remind yourself and ask yourself why you underwrote this asset class in the first place. And my guess is most people would not say the reason they invested in private debt in the first place is because they wanted full access to their capital at all times, or that they thought there would never be a period where credit losses would show up, or that they thought the historical 9% or so returns would be delivered in a straight line. I don't think anyone, if they're being honest, is saying that's why they got into it. And so I think a lot of people today, the ones that are sticking through it and being disciplined, are the ones that said, hey, has anything changed? When we underwrote this 3, 4, 5 years ago and gained conviction, and as this is a part of our portfolio, are all those reasons still valid? And if so, what are we doing here? Why should we be spinning our wheels to try to wrestle with, should we get in or get out or stay in when nothing fundamentally has changed? So I think that's an important consideration too, is just always re-underwrite, go back to why you were attracted to this in the first place, and see if that thesis has remained intact. To your question on maybe biggest misconceptions around private credit today, I would just say that the opinions are just maybe a bit too polarized. I think it's okay. It's either a silver bullet in one side, or it's a ticking time bomb on the other. And again, like anything, the answer is going to be somewhere in the middle. It's not risk-free. You shouldn't be, again, the liquidity features in terms of these structures that are seeing elevated redemptions are well communicated and well known in advance. They're features, not bugs. They're there to protect remaining shareholders, provide some liquidity to investors, but you also have to have some guardrails on that, because ultimately the underlying investments in these semi-liquid structures are themselves illiquid. And so you can't have full liquidity available. You need to have some restrictions on that. And again, these are terms that are well documented out there. Investors, I think, again, should expect over a full cycle that income is going to drive returns. And what we find is that the income piece historically has been around 10%, and that's typically been in a pretty tight range of, call it 8 to 12% on the income side. And that income comes from two sources. It's from short-term floating rates and a credit spread on top of that. And those two variables will fluctuate over time based on market conditions and supply demand dynamics, et cetera. But over time, you should expect the income in line with what it's done in history, which is kind of 10%. And then you factor in some estimate for credit losses, which we talked about earlier. And then you have estimates around fees and expenses, et cetera. So the math for this asset class is relatively simple. You're not making big bets on some future outcome or appreciation or valuation. It's really more, you're lending on a finite basis, and you expect to be paid back at par and collect income along the way. And we think that dynamic will continue to play out over time.
Yeah, that is super helpful. That is a really good deep dive covering the private credit space. This will be an evergreen resource for clients. I think very helpful for people in deepening their understanding. You just talked wrapping up, getting par at maturity, collecting the income. I think in a bull market, there's some folks that can lose a little sight when other areas are growing. They just don't understand why they have it, why those important staples. So those fundamentals are really key when constructing a portfolio and having asset classes. And love to have you back. Maybe we'll queue up another topic. And I'm thinking even within all the private credit or private space, maybe comment on some other areas. Relative attractiveness. Is private credit highly attractive? Are you seeing other spaces that maybe more or less there's probably some ebb and flow on that as conditions go? But this is terrific. I want to give you a shot at the kind of any final words, although we've covered a ton. Anything else we might have missed or that you think you should share before we wrap up here?
I think we covered all the bases.
Yeah.
Obviously, I would love to come back at some point. I always enjoy these with you. And so maybe just at the risk of not being too repetitive on these
Yeah.
episodes, maybe next, since we've done a lot on private equity and private credit, maybe next time we tee up something in the real asset space, real estate infrastructure. That might be, it's a growing topic of interest for us here at Cliffwater, and maybe something that would be helpful and valuable to your listeners.
That'd be super helpful. Yeah, those are areas we're taking a really close look at and allocating to. So love to hear your insights. Love to have you back. I think this is about your fifth appearance. So I'm trying to find a green jacket to present to you. But so if anybody
Well,
has a great source of that.
maybe a robe or something. It's like the Five Timers Club on SNL for those that follow that. So just, yeah, I'm a 42 regular is my size in case you're wondering, but yeah, we'll keep the streak going.
It sounds fantastic. Really appreciate it, Phil. This is super helpful. This, again, will be an evergreen resource. Thank you. Thanks for folks for listening. Please, if you're enjoying this, like it, share it. I think it could be super helpful if you know someone or you're having a conversation and they're concerned about private credit or they don't understand it. This is a source of excellent information. It's not the clickbait that you might just see if you just put it into the typical search engine. That's what we're trying to do on this podcast, have super helpful, educational, deep dive discussions and bringing on experts like Phil who really know the space and trying to create value in a no-cost way for our clients, for our contacts, and for the general public who's listening in about 112 countries, I'm told. Super appreciate you being here, Phil, and to everyone, thanks for joining in as well, and make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.